Imagine this. Your student gets a big scholarship. It's amazing news, right? A huge cause for celebration. But then, tax season rolls around and suddenly you see this weird, unexpected income on your tax return. And it's coming from your own 529 plan. Now, this isn't a mistake. It's actually a required calculation, and it's triggered by a conflict between two different parts of the tax code. It's called Scholarship Displacement. And in this explainer, we are going to do a deep dive and walk through every single step, the rules, the regulations, and how to report it correctly. Okay, so here's how we're going to tackle this. First, we'll look at the root of the problem, the conflict in the tax code itself. Then we'll see what actually triggers this whole event. After that, we'll get into the numbers and calculate the financial hit. Then, and this is the good part, we'll cover the critical exception that saves you from a penalty. And finally, we'll walk through exactly how to report everything so you're totally compliant with the IRS.
All right, to really get this, we have to start at the very beginning. And that's this fundamental mismatch between the rules for 529 plans and the rules for tax-free scholarships. You see, they're defined in two totally separate parts of the Internal Revenue Code, and their definitions of what counts as a qualified expense just don't line up perfectly.
And this right here, this is the core of the whole issue. You see, under Internal Revenue Code Section 529, the whole point is to help you save for a wide range of college costs. That's why it specifically includes things like room and board. But on the other hand, IRC Section 117 is way more narrow. Its only job is to define what makes a scholarship tax-free, so it's limited to direct academic costs. See what's missing? Room and board. That one little difference is what creates this entire tax trap. So, how does this conflict actually cause a problem? Well, it all comes down to a very specific calculation the IRS makes you do. It's designed to stop you from getting a double tax benefit. And the result of this calculation is what's called your Adjusted Qualified Education Expenses, or AQEE for short. This formula, which you can find in IRS Publication 970, is really the heart of the matter. You take the student's total qualified expenses for the year, and then you have to subtract dollar for dollar every bit of tax-free educational aid they received. This subtraction is the displacement. Every tax-free dollar from a scholarship literally knocks out a dollar of 529 money that you can withdraw tax-free. And here's a really crucial point. The term tax-free educational assistance is super broad. We're not just talking about private scholarships. Nope. This bucket also includes things like federal Pell Grants, veterans benefits, like the post-9/11 GI Bill, and even tax-free tuition help from an employer. The only thing that's really excluded are gifts from family. Pretty much everything else reduces your AQE.
Okay, so what happens when the amount of money you pull from your 529 plan is more than your new lower AQEE? Well, that extra amount is considered a non-qualified distribution. But, and this is important, the whole excess amount isn't taxable. Now we have to figure out just the taxable part, and that takes a very specific pro-rata calculation.
You know, you might be thinking, well, can I just say that extra money was my own contributions coming back to me? And the answer from the IRS is a hard no. You can't do that. Instead, under the rules of IRC Section 72, every single dollar you take out of a 529 plan is treated as being a little bit of your original contributions. That's the basis, and a little bit of the investment growth, the earnings. Only that earnings part is what can be taxed. Now, this is really interesting when you look at the Form 1099-Q you get in the mail. The 529 plan administrator sends one to you and one to the IRS. Box 1 shows how much you took out in total. Box 3 is your contributions, which are never taxed, and Box 2 shows the total earnings in that withdrawal. But here's the absolute key for compliance. The 1099-Q knows nothing about your student scholarships. It has no idea what your AQE is. It's just reporting the raw data. It's 100% your job to do the math and figure out the actual taxable amount on your return. And here's exactly how you do that math. Step 1, figure out your final AQE. Step 2, look at your 1099-Q and grab the total earnings number from Box 2. Step 3 is the tricky part. You have to calculate a ratio. You divide your AQE by the total distribution from Box 1. This gives you the percentage of the withdrawal that was qualified. Then you multiply that percentage by your total earnings to find out how much of the earnings are tax-free. And finally, step 4, you just subtract the tax-free earnings from the total earnings. And boom, that's your taxable income. Okay, so we figured out that, yes, some of that 529 money is now taxable income. If you know anything about these accounts, I know what your next question is. Oh no, do I also have to pay that dreaded 10% penalty? And that question is the source of so much stress.
and for a good reason. That 10% additional tax is the government's main way of making sure you don't use 529 funds for, a vacation instead of tuition. Well, the answer, thankfully, is a clear, unambiguous no. And this isn't some shady loophole. It is a specific relief provision that Congress wrote directly into the law. And here's your proof right from the source. The authority comes from IRC Section 529C6, which points over to the penalty exceptions listed for covered ill accounts. Congress put this in because they recognize that you shouldn't be penalized for a good thing, like your kid winning a scholarship. So while the earnings do become taxable, that extra 10% hit is officially and legally waived. And just for some context, it's good to know this scholarship waiver is one of several exceptions in the code. There's similar relief for other major life events that are pretty much out of your control, like the death or permanent disability of the student, or if they go to a military academy. It just shows that the law is really trying to penalize abuse of the system, not these kinds of unforeseen circumstances. All right, let's bring it all home. We know the rules, we've done the math. Now let's talk about the final practical part, reporting. We'll walk through exactly how to put this on a Form 1040 correctly so you're totally compliant. And maybe more importantly, you don't get one of those scary automated letters from the IRS about underreported income. So the very first thing to do is figure out who actually has to report the income. And the rule is simple. The tax liability follows the Social Security number on the Form 1099-Q. So if the money was sent to the student, they are the one who reports it. And this can actually be a great strategy because the student is probably in a 0% or maybe a 10% tax bracket, much lower than their parents. This table is basically your roadmap for the tax forms. The taxable earnings you calculated, that goes on Schedule 1 of the 1040 on line 8Z as other income. Then, and this part is absolutely not optional, you have to file Form 5329 to officially claim the penalty waiver. The result from that form, which will be 0, flows over to Schedule 2, line 8. This whole process tells the IRS that you know the rules and that no penalty is due. Think of Form 5329 as you proactively communicating with the IRS. You're basically raising your hand and saying, hey, I know this looks weird, but here's why it's correct. You put the taxable earnings on line 5. On line 6, you enter that exact same amount again because it's all subject to an exception. Then, and this is the most critical part, next to that line, you write in exception code 04. That's the specific code for a scholarship. That code is what the IRS computers are looking for. It tells the system to stand down and not send you a penalty notice. Whew, okay, that was a pretty deep dive into the tax code. Let's pull back for a second and just quickly summarize the most important things you need to remember from all this. Let's recap the big 4 points. 1. Scholarships and other tax-free aid directly lower your AQE. 2. If you take out more from your 529 than that new lower AQE, a portion of the earnings will be taxable. 3. Even though it's taxable, the 10% penalty is completely waived by law. And 4. You absolutely must report this correctly using Schedule 1 and, crucially, Form 5329 to stay out of trouble. And I'm going to leave you with this one last critical question. We figured out the whole federal side of things, but what about your state? See, a lot of states that give you a tax deduction for putting money into a 529 have rules to recapture or claw back that deduction if you take it out for non-qualified reasons. So the final piece of your homework is to check your state's tax laws. Do they follow the federal government's lead and waive the penalty, or will they hit you with a state tax bill? That is the final hurdle you need to clear.